the asset management arm of Prudential Financial. This is, look, I understand it's not easy, this, but
it's not.
We've got contradictory signals. So, for instance, the lower oil price comes because of the COVID and the slowdown, but the supply chain issues puts up our inflation overseas. The central bank is lowering rates while everybody else is raising them. Square the circle, David.
Well, Richard, I think it's not an easy circle to get through the square at all. It's actually very complicated. And after many years where a lot of countries were operating with very similar economic conditions, we now find a wide variety of situations as we look around the globe. They may have inflation and recession as themes, but they're actually very different. In Europe, you have inflation that's driven for the most part by high energy, and you actually have countries that are now in or soon going into a recession. In China, as you pointed out, growth is slowing, but we actually believe it will continue to slow from where it is. But that will be a dampener on demand, but unlikely to go into an actual recession.
Right.
And here in the U.S., we have an even more complicated situation.
Oh, go on.
Yeah, well, last week, you saw the best example that we've seen is the market wants to believe. They want to believe we are going to have a soft landing. And last week when we had, the inflation numbers come in below expectations and there was some real hope that things were actually looking better, you saw risk assets around the world really beginning to rally. But at the same time, if you look out at the forward curves and you say, do we really think that the Fed is going to be reducing interest rates by March of next year, which is what the markets are telling you right now? Personally, I don't believe that. The U.S. economy is actually very strong, whether you look at employment or whether or not you look at consumer or... David,
yep, go ahead. So, I want to just jump there. But all right, so let's say that there's an entire generation of people who've never seen a real recession, and who don't realize that monetary tightening takes at least a year to 18 months to do its proper business, particularly from these very elevated levels.
Right.
But you could still have a return to a sort of a bull market if the prognosis is one of solid growth ahead.
No, you absolutely could, but I don't think that that's at least certainly not our initial planning view at all. We actually think that even as we go through this over the next 18 months as long-term investors, that actually we will go back to a fairly low productivity, low growth, low rates environment as we look out over the next couple of years. We haven't seen anything that once we get through the disruptions of the pandemic that's changed our view on the fundamentals of productivity, which at the end of the day is the only thing that can really change in the long term the outlook on growth. So for the U.S., we think that the soft landing is possible but not likely, and we absolutely see a soft recession coming through toward the end of 23 as the Fed continues to have to hike rates in order to get inflation back under control.
Now, by this recession at the end of next year, which is very similar to what's now starting to become a consensus. You were ahead of the game on that one when you came out with that earlier on. But as we head towards that, the technical recession, and that's my words, that we've just had of two negative quarters, you're really talking about a real recession where you've got a loss of jobs, you've got rising unemployment, and you've got negative GDP.
Absolutely. I would not read too much into the GDP quarterly flash figures that we see. I know there's people like the kind of rule of thumb of 2 consecutive quarters, but the reality of when we're actually in a recession will be a much more balanced view of what's happening to wages, what's happening to jobs, what's happening to inflation, and what's happening to output all together. And I don't think you can make a case right now that the U.S. is even close to being in a recession.
Can we enjoy growth without China? Is China now such an integral part of the global economy that without China pulling everybody up, there'll be problems?
Well, as you said, it's complicated because on the one hand, we need the demand from China. Mm-hmm. On the other hand, if China slows, it actually makes getting inflation under control somewhat easier. In particular, I would point out energy prices, where you've already seen this week some reaction to that, and I think you'll continue to see that. So in the short term, actually having China slow, we would argue, is a bit helpful to the economic condition in the U.S.
Do you see a crisis in the Eurozone over bonds. Now, I know the ECB's come up with its unique system of buying the bonds of the countries that are in the tail of the wagon, so to speak. But, you know, the speed with which they did that suggests that they are seriously worried about a debt crisis.
Well, I think that you know, they certainly saw the movie from a couple of years ago where we saw particularly Italian bonds really gap out versus German. And I think they've learned the lessons from that. So they wanted to get ahead of it this time. That said, I think you're right to point it out as clearly a risk. I do think the Eurozone overall will be in recession, probably is now and will be shortly. And so you're going to see increased pressure without a doubt, both on sovereigns and on some of the corporate debt there as well.
Right. Okay. Asset management time. And I'll emphasize that, you know, we don't give advice as such on this program, but everybody looks at their portfolio and says, things are cheap. Things are relatively cheap. Stocks, I mean, even if they were overvalued before. And if I'm taking a long-term horizon of 5 years, is now the time to be nibbling?
So, Richard, as one of the largest asset managers in the world, we obviously do take that long-term view. And I would re-emphasize that risk is not the same as volatility. And many times, actually, volatility provides an opportunity to actually get in and to buy assets at prices that you couldn't do otherwise. Our view is that when history is written of the next 18 months, this will be some of the best time to be actually putting money to work, probably quite a bit better than it was 1 year ago from now. So I really think that we're not there yet. We want to see inflation beginning to come down before we take that step into risk assets. But once that inflation does clearly begin to come down, we will. And I think actually you will see this as quite a good time for investing.
Brilliant to have you on the program, David. Thank you so much.
Richard.
And thank you for
nice to see you.